Welcome to Charged Alpha. I'm Hudson, and with me is Lana. Today we're breaking down the full company story for Walt Disney.
That's right. Before the earnings numbers, let's understand exactly what Disney is, how it makes money, and what makes it built to last.
Walt Disney was founded in 1923 by brothers Walt and Roy. What began as a California animation studio grew into one of the most recognized brands on the planet.
The core of Disney is its intellectual property. Marvel, Star Wars, Pixar, and Disney Animation form a storytelling library with multi-generational appeal across every format imaginable.
Disney operates in two major divisions. Entertainment covers streaming, studios, and broadcast networks. Experiences covers theme parks, cruise lines, and consumer products.
The Experiences segment is Disney's most profitable. Theme parks like Walt Disney World and Disneyland convert beloved characters into real-world spending, a flywheel that competitors simply cannot replicate.
Disney Plus launched in 2019 and reached tens of millions of subscribers faster than nearly any streaming service before it. The Marvel and Star Wars franchises drove initial subscriber growth.
The key tension at Disney is cord-cutting. ABC, ESPN, and the cable networks still generate substantial revenue, but linear TV audiences are declining as consumers shift to streaming.
ESPN is at the center of Disney's strategic transformation. The plan is to move ESPN from a cable-dependent model to a direct-to-consumer sports streaming service available to subscribers independently.
Bob Iger returned as CEO in late 2022 after Bob Chapek's tenure ended under pressure. Iger's mandate was to restructure costs, refocus creative priorities, and define Disney's streaming path to profitability.
Iger's track record includes transformative acquisitions: Pixar in 2006, Marvel in 2009, Lucasfilm in 2012, and 21st Century Fox in 2019. Those deals assembled the current IP portfolio.
Disney's competitive moat comes from three places: the IP library itself, the theme park network that monetizes characters in the physical world, and a distribution platform spanning streaming and broadcast.
Peers include Netflix on the streaming side and Comcast's NBC Universal in the broader entertainment space. Disney's parks business has no direct streaming competitor analog.
Disney reinstated its dividend in 2023 after suspending it during the pandemic. The dividend has grown modestly since reinstatement, signaling returning confidence in cash generation.
Parks drive the highest margins in the portfolio. Per capita guest spending has risen consistently as Disney has expanded premium experiences, multi-day packages, and Lightning Lane pricing.
Globally, Disney operates resorts in California, Florida, Tokyo, Paris, Hong Kong, and Shanghai. International parks are often structured as joint ventures, limiting balance sheet exposure.
The studio entertainment arm, theatrical films, remains a volatile but high-profile contributor. Box office hits from Marvel and Pixar can generate hundreds of millions in a single opening weekend.
For long-term investors, Disney is a bet on storytelling, scarcity of iconic IP, and the enduring power of emotional connection between audiences and beloved characters across generations.
The company's challenge is navigating the transition from a linear TV cash engine to a streaming-first model while maintaining the high-margin parks and studios business alongside.
That's the full Disney company chapter. One of the most storied franchises in business history, navigating a media transition that will define its next century.
Now that we have the full picture, let's get into how the latest quarter actually played out.
Into the numbers we go.
Walt Disney beat Q1 fiscal 2026 earnings estimates across the board. Adjusted EPS of $1.35 topped the $1.28 estimate by approximately 5%. Revenue of $25.98 billion beat the $25.5 billion consensus. Streaming finally reached profitability, parks are expanding, and new CEO Josh D'Amaro stepped in from a parks background. This is Charged Alpha. I'm Hudson.
And I'm Lana. The Walt Disney Company is one of the world's largest entertainment conglomerates, operating three core segments: entertainment, which includes Disney Plus, Hulu, ESPN Plus, ABC, and the film studios behind Marvel, Pixar, Lucasfilm, and Walt Disney Animation; experiences, theme parks and resorts worldwide, and sports anchored by ESPN. Founded in 1923 by Walt and Roy Disney, the company today sits at a market cap of approximately $190 billion.
Josh D'Amaro became CEO in March 2026, succeeding Bob Iger, who had returned in late 2022 to stabilize the streaming transition. D'Amaro spent 27 years at Disney, most recently running the Parks division, the highest margin, most capital-intensive part of the enterprise. His ascension signals that the Parks and Experiences flywheel is Disney's primary growth engine going forward.
Starting with Disney's financials, Q1 fiscal 2026 revenue of $25.98 billion beat the $25.5 billion consensus. This was Disney's holiday quarter, October through December 2025, historically the strongest quarter for parks, box office, and streaming engagement. Year-over-year revenue grew approximately 5%, driven by the Experiences segment and streaming profitability inflection.
Adjusted EPS of $1.35 beat the $1.28 estimate by approximately 5%. The beat reflects streaming reaching sustained profitability. Disney Plus and Hulu combined generated positive operating income in the quarter. Management reaffirmed double-digit adjusted EPS growth for fiscal 2026 and 2027, a target that requires continued streaming margin expansion and parks volume growth.
The entertainment segment includes Disney Plus, Hulu, and ESPN Plus streaming alongside ABC, linear cable networks, and the film studios. Streaming subscribers for Disney Plus are approximately 150 million globally, with Hulu approaching 52 million domestic subscribers. The content slate, Marvel, Star Wars, Pixar, provides multi-platform monetization, theatrical, streaming, parks, and merchandise, all drawing from the same IP investments.
The Experiences segment, theme parks, cruise lines, and consumer products, is Disney's highest margin business at approximately 26% operating margin. The company has committed $60 billion to parks expansion over the next decade, including World of Frozen at Disneyland Paris, Tropical Americas at Animal Kingdom, and 2 new cruise ships in service by early 2026, with 5 more planned. Parks capacity expansion drives long-duration revenue growth at premium margins.
ESPN is in strategic transition. The standalone ESPN app launched at $29.99 per month, creating a direct-to-consumer sports rights revenue stream independent of linear cable distribution. As cord-cutting accelerates and linear pay TV subscriber counts decline, the ESPN DTC product is critical to retaining sports rights economics in the streaming era. Early subscriber momentum will be a closely watched metric through 2026.
Disney's balance sheet carries total debt of approximately $46.6 billion against a net debt position of roughly $41 billion. Free cash flow of approximately $7 billion annually provides the funding mechanism for the parks expansion program and the doubled $7 billion share buyback authorized for fiscal 2026. The dividend reinstated in fiscal 2024 at $1.25 annually sits at a modest 1.2% yield.
The analyst community is broadly constructive on Disney, with 63 analysts covering the stock and a buy-leaning consensus with an average price target near $131. The 5% EPS beat in the seasonally strongest quarter supports price target upgrades across the coverage universe. Bulls see the stock as attractively priced given the streaming inflection and parks momentum.
The constructive analyst view centers on streaming margin expansion. Disney Plus reached profitability faster than skeptics modeled, and the path to 10% operating margins for the entertainment streaming segment is becoming more credible. Bulls model streaming operating income compounding at high rates as subscriber growth moderates, but average revenue per user, from price increases and advertising tier adoption, drives margin expansion.
The ESPN DTC strategy is a second major bull thesis. Analysts who believe Disney can retain its sports rights economics through direct-to-consumer distribution see the ESPN standalone app as a re-rating catalyst. Legacy cable bundle economics allocated significant revenue to ESPN through affiliate fees. The DTC product must match or exceed that revenue per subscriber to justify the transition from the distributor model to direct.
Skeptical analysts focus on linear TV structural decline. Disney's domestic broadcast and cable network revenue fell 16%, and operating income dropped 21% in recent quarters. The legacy linear business is a declining cash engine, funding the streaming build, and the transition timeline from cash generation to streaming profit replacement is the central modeling debate for bearish analysts who set hold or sell ratings.
The CEO transition is a fresh valuation question for the analyst community. Josh D'Amaro succeeds Bob Iger with deep parks expertise but limited enterprise-level CEO experience. Investors who trust Iger's strategic framework, streaming plus parks plus IP flywheel, view D'Amaro as an execution-focused continuation. Skeptics who wanted a media industry veteran from outside parks will watch his first strategic communications closely for any course changes.
The bull case for Disney starts with the IP flywheel compounding across segments. Marvel, Star Wars, Pixar, and Disney animation characters generate box office, streaming subscriptions, park visits, and merchandise purchases from the same underlying investment. No competitor can replicate this multi-platform monetization structure at Disney's scale, and the IP library has demonstrated multi-generational demand durability.
Parks profitability is the bull case's financial engine. The experiences segment has maintained approximately 26% operating margins while adding pricing power through premium product tiering, Lightning Lane, Club 33, Disney Genie, that monetize the brand relationship at price points well above traditional park admission. The $60 billion expansion program deploys that economics engine into incremental capacity over the next decade.
The buyback program adds a capital return floor to the bull case. $7 billion in authorized fiscal 2026 buybacks at a sub-20 times earnings valuation creates meaningful EPS accretion. Bulls model the combination of streaming margin expansion, parks volume growth, and buyback-driven EPS growth compounding through 2027, with the stock price multiple re-rating as streaming profitability becomes established and durable.
The bear case for Disney leads with linear TV's structural decline. Disney's domestic networks generate significant operating income that is declining as pay TV subscriptions erode. Bears model linear income falling at a rate streaming profitability cannot fully offset in the near term, creating aggregate earnings pressure even as the streaming narrative improves.
Content cost inflation is a persistent bear concern. Disney's competitive streaming positioning requires consistent high-quality output and a miss in theatrical box office. A single underperforming Marvel or Pixar film can create significant impairment flowing through the income statement, producing earnings volatility that is difficult to model in advance.
Capital intensity is the bear case's financial constraint. The $60 billion parks commitment requires sustained free cash flow over a decade while also funding streaming content, dividends, and buybacks. Bears who model a park attendance slowdown from macro weakness see the capital plan as overextended for the available cash flow base.
CEO transition risk is the fourth bear concern. D'Amaro inherits a complex enterprise mid-transformation with the streaming build unfinished and the ESPN direct-to-consumer launch in its first year. Bears question whether a parks executive is the right choice for a company whose primary challenge remains a media distribution transformation.
Netflix is Disney's primary streaming peer. Netflix trades at more than 3 times Disney's valuation multiple, reflecting the market's reward for Netflix's subscriber scale and its absence of a declining linear business. Disney's streaming profitability inflection narrows the justification for the gap, but Netflix's pure-play identity commands a premium sense. Disney's conglomerate structure may not fully close.
Comcast is the closest peer for Disney's combined streaming and parks model. Comcast's NBC Universal operates Peacock streaming and Universal theme parks alongside legacy cable and NBC broadcast. Universal's Epic Universe expansion in Orlando and Peacock's sports rights investments represent the most direct competitive threat to Disney's parks and streaming flywheel in the domestic market.
Warner Bros. Discovery is the distressed peer comparison. WBD trades at 9 times earnings with significant merger debt while managing HBO Max subscriber growth and network restructuring. Disney's balance sheet health and IP depth command a structural premium over WBD, though WBD's HBO brand provides genuine competitive positioning in prestige streaming content.
On valuation, Disney at 14 to 17 times forward earnings sits between Netflix's premium and WBD's distressed multiple. The mid-market valuation reflects conglomerate complexity. streaming growth, and parks profitability offset by linear decline and debt load. Bulls argue Disney deserves closer to Netflix's multiple as streaming margins are established. Bears argue the conglomerate discount is permanent.
Disney's options market activity ahead of Q1 fiscal 2026 earnings reflected moderate implied volatility, consistent with a large-cap entertainment company where event risk is about guidance tone rather than binary beat or miss. Pre-earnings positioning was balanced, and the modest EPS beat produced a constructive stock reaction without the volatility spike a guidance cut would have triggered.
Post-earnings implied volatility declined as the EPS beat and reaffirmed double-digit growth guidance resolved the event risk. Disney's beta of approximately 1.3 positions the stock as a moderate market amplifier. Options market activity following earnings showed call buying on the streaming margin expansion theme, consistent with institutional positioning for the fiscal 2026 narrative.
Insider activity at Disney reflects the CEO transition period. Bob Iger's planned stock dispositions during his exit were typical of executive transitions. Josh D'Amaro joined the top rank with equity compensation rebuilt under a new performance structure tied to parks and enterprise targets. No notable open market purchases were reported in the most recent 90-day window, standard early transition behavior.
The combined read from options and insider data is neutral to constructive. Pre-earnings implied volatility reflected genuine uncertainty around the streaming profitability question. The EPS beat resolved event risk constructively. Insider activity shows standard transition patterns without open market conviction signals. For Disney, the investment thesis turns on streaming margin trajectory and parks capacity execution, both of which Q1 fiscal 2026 supported.
Disney beat Q1 fiscal 2026 EPS by approximately 5%, while streaming turned profitable and parks delivered premium margins. Management reaffirmed double-digit adjusted EPS growth for fiscal 2026.
Bottom line, the IP flywheel is intact, streaming profitability is confirmed, and Josh D'Amaro inherits a company executing its transformation. The linear decline is the discount, and the parks and streaming compound is the thesis.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.